Hi everyone, my name is Fischer, also known as the New York City Broker. Today I'm going to share some tips with you discussing what is an appraisal. So what is an appraisal? A real estate appraisal or property appraisal is a process in which the actual market value of a property is determined by a third-party, non-biased professional called an appraiser. The actual market value of the property is different from the price the seller wants or the price the buyer is willing to pay. It's what the bank or the mortgage lender considers the real value of the property and uses it to calculate the loan value. The property can be any type of real estate, whether it's residential, condos and co-ops, or commercial, like retail shops or offices. Appraisers are professionals who know how to calculate the price of a property at a specific time. They are unbiased, so they don't come up with a value that intentionally benefits the buyer or the seller. So how long is an appraisal valid? It is important to understand that an appraisal usually has a short expiration date. Some appraisals are valid for up to 6 months, others are valid for only 3 months. That's because the changing market conditions may affect the value of the property. How is a property appraised? Appraisers, the professionals tasked with appraising the property and coming up with a fair market value for it, look at 2 main aspects. Number 1, the property itself, and number 2, similar properties sold in the vicinity, also known as comparables or comps for short. In the property, they look at things like size, condition, age, location, neighborhood. Newer and improved properties might sell for a higher price than worn down or older properties. The location, such as how close the property is to a subway station or a large food market like Whole Foods or Trader Joe's, can also influence its price. Recently sold properties make for better comps because they offer appraisers the freshest idea of the market. The more comps there are, the better and more accurate the appraisal is likely to be. So what about property appraisals? Who is it for and when does it happen? A property appraisal is for the bank and/or the mortgage lender. The bank wants to make sure that the money they give to the home buyer or borrower is secure. They don't issue the loan for any more than the property is worth, so that if it comes to selling the property to recover their losses, they don't lose any money. The appraisal is done before finalizing the mortgage and usually after the buyer and the seller have negotiated a price, since most banks need a fully executed contract prior to scheduling it. Who pays for it? The home buyer, who is also the borrower, pays for the appraisal. Once the bank has the appraisal report, they determine how much mortgage loan they will issue using something called loan to value or LTV. What is loan to value in real estate? A loan to value is the ratio of how much loan you are taking from the bank and what your property is valued at. For example, if the appraised value and the final selling price of a property is $1 million and you saved up 20% or $200,000 for the down payment, you'll need to borrow $800,000, which is the loan value. Your loan to value ratio would be $800,000 divided by $1 million, which is 80%. So your LTV would be 80%. Since you assume a decent amount of risk by paying for 1/5 or 20% of the property yourself, the bank might give you a lower interest rate. If your LTV is higher, like around 90%, or you're only paying for 10% of the property, the mortgage interest rate will most likely be higher. And you might be required to pay for private mortgage insurance or PMI unless banks offer a specific type of program. It can be more difficult to find a building that only allows 10% down in New York City, and co-ops will not allow less than 20%. Other facts like your credit score and history impact your interest rate, but LTV also plays an important role. Also, some banks or mortgage lenders might have specific LTV cutoffs for different properties, like co-ops and condos. And you might not be able to take more than a certain portion of your property's appraised value, like 80%, as a loan. Can you buy a home without a property appraisal? Yes, you can waive the property appraisal if you are paying all cash and not taking out a loan. But when a mortgage lender is involved, this isn't possible. An appraisal is compulsory before they can underwrite and process a mortgage loan. What's a low appraisal? A low appraisal is when an appraiser determines that the property is worth less than what you've agreed to buy it for. If it's a minor difference, it's easy to cover with your down payment. But if the difference is significant, you may negotiate the price down, get another appraisal, or challenge the appraisal after conducting your own research. If you have an appraisal contingency, depending on the terms of the deal, you may be able to legally back out of the transaction without any penalty. Thanks so much for joining me in this discussion regarding what is an appraisal. If you have additional questions, please feel free to reach out to me at brett@thenewyorkcitybroker.com. Also, don't forget to like, share, and subscribe so that you, your friends, and your family members can get all the best real estate content. I'm Brett Fischer, the New York City Broker. Have a great day.